To enter the sphere of true dynastic wealth is to step into a room where the air has been pumped out and replaced with something rarer, thinner, and infinitely more expensive. It is a silence that has been purchased at great cost, a quietude that does not merely suggest the absence of noise, but the total suppression of the chaotic, unmanageable world outside. In the grand drawing rooms of Newport, or the hushed mahogany-lined boardrooms of Lower Manhattan, one notices first the texture of things. The heavy, light-absorbing velvet of the drapes, the coolness of marble that seems to hold the chill of a quarry centuries depleted, and the peculiar, metallic scent of ink drying on vellum. There is a sense of observation here, a feeling that the objects themselves, the Chippendale chairs, the portraits of severe ancestors, the very architecture are watching, judging, and waiting. This is not the loud, brash wealth of the lottery winner or the tech mogul, which screams for validation. This is old money, and its primary characteristic is a terrified, aggressive desire for preservation. It is a living entity, a creature that breathes and feeds, and like any organism faced with an existential threat, it evolves. To understand the modern architecture of this silence, one must look back to the moment the sky fell and the golden age shattered into the gray dust of the Great Depression. For it was in the wreckage of 1929 that the very concept of the family office, the invisible engine of the aristocracy, was truly forged. The crash of 1929 was not merely a financial event. It was a psychological trauma that fundamentally rewired the neural pathways of the American elite. Before that Black October, wealth was often managed with a cavalier informality, a loose association of personal secretaries, trusted lawyers, and perhaps a favored bank manager who knew better than to ask questions. The Gilded Age titans, the Vanderbilts, the Astors, the Carnegies, wielded their fortunes like blunt instruments, focused on expansion, acquisition, and the visible projection of power. But as the ticker tape lagged behind the sell orders and the bodies of ruined speculators hit the pavement of Wall Street, the surviving dynasties realized that the game had changed. The goal was no longer to conquer the world. It was to build a fortress that could withstand the world's collapse. The panic exposed the fragility of reliance on external institutions. Banks failed, brokerages evaporated, and the trusted advisors of yesterday were revealed to be as helpless as the common man. In the cold light of the 1930s, the great families withdrew. They pulled their capital from the public square and retreated into the shadows, birthing the modern single-family office, a private corporation whose only product was the survival of a specific bloodline. This retreat was driven by more than just market volatility. It was a response to a new and formidable predator, the state. The political climate of the 1930s, under the stewardship of Franklin Delano Roosevelt, turned openly hostile to the accumulation of stagnant capital. The Revenue Act of 1935, often referred to by its detractors as the Soak the Rich Act, introduced a progressive tax structure that terrified the upper class, pushing the top marginal tax rate to 79% and, more significantly, raising estate taxes to levels that threatened to dismantle dynasties within a single generation. This is where the narrative shifts from mere history to a study in complex adaptation. The wealthy realized that death had become a taxable event of catastrophic proportions. If a patriarch died, the state would claim nearly half the empire, forcing the heirs to liquidate illiquid assets, family estates, art collections, controlling stakes in corporations just to pay the bill. The family office ceased to be a luxury and became a survival mechanism, a sophisticated legal and financial bunker designed to intercept the taxman before he could reach the vault. One must look to the pioneering structure of the Phipps family to understand this evolution. Henry Phipps, a partner of Andrew Carnegie in Carnegie Steel, had already established the Bessemer Trust in 1907, but it was in the post-Depression era that such structures became the template for the aristocracy. The Phipps family did not merely hire money managers, they created a self-contained financial ecosystem. By establishing a private trust company, they effectively removed their wealth from the cycles of human mortality. The assets were no longer owned by individuals who could die and be taxed. They were owned by the trust, a legal fiction that could theoretically live forever. This distinction is crucial and often misunderstood by the layman. In the world of high finance, ownership is a liability, while control is power. The family office boom of the 1930s was essentially a mass migration of assets from the vulnerability of personal names into the impregnable armor of corporate and trust structures. It was a vanishing act, performed in plain sight, where billions of dollars slipped behind a veil of bureaucracy, protected by the very laws designed to regulate them. The internal logic of these offices was distinct from any commercial bank. In a commercial bank, the goal is quarterly profit. In a family office, the timeline is measured in centuries. This shift in temporal perspective altered the nature of investment itself. The preservation of capital became the religious dogma of the post-Depression era. The newly formed offices of the 1930s moved away from the volatile equity markets that had burned them in 29 and poured capital into real assets, timberland, commercial real estate, municipal bonds, and gold. They sought assets that were unglamorous, often invisible to the public eye, but which provided a steady, unbreakable stream of income. Consider the Pitcairn family, heirs to the Pittsburgh plate glass fortune. Their family office did not just manage money, it managed the family itself. As the generations expanded, the number of heirs multiplied, diluting the fortune and increasing the potential for internecine conflict. The office became the adjudicator, the disciplinarian, and the glue. It established governance structures that dictated how heirs could access their money, often tying distributions to behavior, education, or gainful employment. The money became a tool of social engineering, shaping the character of the descendants to ensure they were fit guardians of the legacy. It is in the minutiae of the tax code that one finds the true genius of this era. The lawyers employed by these nascent family offices in the 1930s began to exploit the rule against perpetuities, an ancient common law principle meant to prevent people from controlling property long after their deaths. The rule generally stated that a trust could only last for a life in being plus 21 years. However, the legal minds of the aristocracy began to lobby for and identify jurisdictions that would relax or abolish this rule. This search for the perpetual trust turned states like Delaware and later South Dakota into internal tax havens. The family offices established during the Depression began to utilize the generation-skipping transfer, a method where assets were passed not to children, but to grandchildren or great-grandchildren, thereby skipping a cycle of estate taxes. While the government eventually closed some of these loopholes in later decades, the foundations laid in the 30s allowed for the accumulation of compound interest over decades without the interruption of the tax collector. It was a mathematical miracle, a way of bending time to serve the interests of the few. The psychological atmosphere within these offices was, and remains, one of paranoid discretion. In the 1920s, a tycoon might have bragged about his stock positions to a reporter. By 1935, that same tycoon, guided by his family office directors, would have gone to great lengths to ensure his name appeared on no public ledgers. This was the birth of stealth wealth. The offices were often located in nondescript buildings, with plaques that bore generic names like Argus Management or Standard Associates, giving no hint of the billions moving through their wires. The staff, accountants, tax attorneys, investment chiefs were sworn to a secrecy that rivaled the intelligence services. They knew the mistresses, the addictions, the illegitimate children, and the political bribes. They managed the fixers who kept the family name out of the police blotters. The family office became the repository of the family's sins as well as its treasures, binding the staff and the family together in a pact of mutual assured destruction. The silence was not just a preference. It was a contractual obligation. As the Depression wore on, the family office evolved from a defensive shield into an offensive weapon. With cash being king in a deflationary environment, these offices found themselves in a unique position. While the rest of the world was selling, they were buying. They purchased distressed assets at pennies on the dollar, consolidating entire industries under the guise of anonymous holding companies. This period saw the quiet accumulation of vast tracts of American land and resources. The Rockefeller family office, known famously as Room 5600 in Rockefeller Center, is the archetype of this expansion. It was not merely an investment firm. It was a philanthropic engine, a political lobbying arm, and a venture capital fund rolled into one. They understood that to preserve wealth in a hostile political environment, one had to buy influence. The family office began to fund think tanks, universities, and cultural institutions, subtly shaping public opinion and policy to be more favorable to the interests of capital. They realized that the best way to protect money was to control the narrative of the society that printed it. The architecture of these offices also mirrored the changing social contract. In the Gilded Age, the rich lived in a world physically separate from the poor, but structurally similar. They bought goods and services. The family office created a parallel economy. By the late 1930s, a fully realized office would handle everything in-house: insurance, travel, logistics, art curation, property management, and even medical care. The family members ceased to be consumers in the public marketplace. If they needed a house built, the office's real estate arm managed the contractors. If they needed to travel, the office's aviation division arranged the aircraft. This isolation deepened the psychological divide between the ultra-wealthy and the rest of the citizenry. They were no longer swimming in the same stream. They were in a submarine, navigating the deep waters, pressurized and impenetrable. This total service model meant that an heir could go from the cradle to the grave without ever having to negotiate a transaction with an outsider, further atrophying their ability to relate to the common human experience of risk and reward. One cannot discuss this era without examining the role of the embedded family office within operating companies. Many families, fearing the optics of a separate wealth management firm, buried their private offices within the corporate structures of their primary businesses. Expenses that were personal, the maintenance of a hunting lodge, the salary of a personal driver, the costs of a debutante ball were buried in the ledgers of the public corporation as executive benefits or marketing expenses. The Securities and Exchange Commission was in its infancy, and the lines between corporate and personal capital were deliberately blurred. This practice allowed the dynasties to maintain a lifestyle of opulent excess while reporting modest personal incomes to the Internal Revenue Service. It was a sleight of hand that required a legion of complicit accountants, all orchestrated by the central brain of the family office. The office was the master weaver of a tapestry of lies that looked, from a distance, like perfect legal compliance. The intellectual rigor applied to these operations was staggering. The family offices of the post-Depression era began to employ economists and sociologists to predict long-term trends. They were no longer betting on the price of wheat next month. They were betting on the demographic shifts of the next 40 years. They analyzed the stability of governments, the potential for war, and the shifting tides of labor relations. This was the era where the diversified portfolio truly matured. Recognizing that the United States might not always be a safe harbor, they began to move assets offshore, into the Swiss banking system and the burgeoning tax havens of the Caribbean. This internationalization was sold as risk management, but it was, in effect, a vote of no confidence in the nation-state. The family office allowed capital to become stateless, flowing like water to wherever the barriers were lowest. They constructed a web of shell companies in Liechtenstein, Panama, and the Bahamas, creating a labyrinth that no single government could unravel. It is essential to understand the soft power these offices wielded through the mechanism of philanthropy, which became a tax-advantaged method of retaining control. The charitable foundation, managed by the family office, allowed a dynasty to donate millions to a hospital or university. On the surface, this was altruism. Beneath the surface, it was a transaction. The donation often came with strings-attached positions on the board of trustees, admission preferences for heirs, and the ability to direct research or policy. The tax deduction offset the income from other investments, and the social capital gained was incalculable. The family office transformed charity into a sophisticated instrument of power, where giving money away was just another way of keeping it. The buildings bore their names, carved in stone, a permanent reminder to the public of who owned the very bricks of their institutions. This practice, refined in the 30s and 40s, cemented the aristocracy's place at the helm of American culture, making them the patrons of the arts and sciences, and thus, above reproach. There is a particular case that illustrates the ruthless efficiency of these structures: the separation of the business from the family. In many family offices established during this period, a family council was created, distinct from the investment committee. The council dealt with the emotional and social issues: marriages, divorces, substance abuse, and education. The investment committee, dealing with the hard assets, was often staffed by non-family professionals, cold-blooded technocrats with no emotional attachment to the legacy. This bifurcation was designed to prevent the sentimental whims of an heir from destroying the capital base. If a favored son wanted to invest millions in a foolish theatrical production, the professional managers could veto it, citing the bylaws of the trust. The family office thus saved the family from itself, acting as a rational superego to the id of the spoiled descendant. It was a recognition that biology does not guarantee competence, and that the bloodline needed to be protected from its own dilution of talent. As we scrutinize the legacy of the post-Depression family office boom, we must recognize that we are looking at the blueprints of modern inequality. The structures, designed in those panic-stricken years, the dynasty trusts, the offshore holdcos, the charitable foundations, have proven to be remarkably durable. They were built to withstand a depression, and they have withstood everything since: wars, inflation, tech bubbles, and pandemics. The wealth held in these offices does not trickle down. It circulates internally, growing denser and more potent with each revolution. The silence of the family office is the silence of a black hole, drawing in value and letting nothing escape. The people who established them are long dead, their bodies returned to the earth, but the legal entities they created are immortal. They are the ghosts in the machine of global finance, unkillable and insatiable. In the end, the family office is a testament to the terrifying foresight of the terrified. It is a monument to the realization that in a world of chaos, the only true safety lies in total control. When one walks past the limestone facades of the Upper East Side or the gated estates of quiet, leafy suburbs, one is not just seeing wealth. One is seeing the physical manifestation of a century of legal maneuvering, a defensive architecture designed to ensure that the feast continues forever, behind closed doors, while the rest of the world fights for scraps in the street. The money is no longer just currency. It is a sentinel, standing watch over the past to ensure it dictates the future. And in that silence, if one listens closely, one can hear the steady, rhythmic heartbeat of a fortune that has learned, above all else, how to survive its owners.